Welcome to Trading 212's brand new tutorial series on trading strategies. In this first tutorial, we will go over how to trade breakouts. A breakout occurs when the price breaks out and closes above a resistance level or below a support level. Let's quickly have a look at a candlestick chart to illustrate what support and resistance levels are. A support line can be identified by connecting the low points of an instrument's price. They are identified as low points if the price rebounded upwards right after reaching them. By definition, the support line needs at least 2 points to be formed, but we suggest finding 3 points for a stronger indicator. The support line can be horizontal or angled. Resistance lines are effectively the same as support lines, with the marked difference that they are above the current price and act as a ceiling from which the price falls from. Again, they can be horizontal or angled. When we have a support and resistance line together, they create a trading range, so both lines keep the movement of the price within a certain range until the price makes a break, either above or below. Trading ranges are formed due to supply and demand and market psychology. When the price breaks out of the range, it signals a change in the supply and demand and the beginning of an upward or downward trend. Let's say the price breaks out above the resistance level. At this moment, the resistance line might become a new support level as the supply and demand has shifted, so most likely new levels of support and resistance will be established. So here's the general concept to trading breakouts. You can use the breakout strategy to trade forex, stocks or commodities, and it works with any time frame. It's a method of technical analysis that follows certain rules and can be applied universally. So what's first? First, you need to find a financial instrument, a currency pair, stock or commodity with a clearly defined support or resistance level. We only need one clearly defined support or resistance level to anticipate a breakout. However, a trading range created by both a support and resistance level is more beneficial as you can take advantage of the breakout in either direction, so either above or below the current range. That said, how should you enter your order in a breakout? We will assume that you expect the breakout to be above the current range. So there are several ways to enter the market at a breakout, all depending on your trading style and risk tolerance. The first is at the actual breakout. To trade at the breakout, you would need to devote more time to actually watching the market so that you can place a market order whenever the breakout occurs. This is the most risky entry point as the movement has not been confirmed and there's a high chance that the price will move back into the trading range. The second entry type is a pending order at a price level placed above the current range. This is a preset price level that can be based on the current range or determined by an indicator. We recommend that the price level of the pending order is at a previously unachieved high. It does not require you to watch the market as the order will be executed automatically upon reaching the price. The third entry is to wait for the candle on the time frame you've selected to close above the range, reaching a new high and in this way confirming the breakout. We suggest that you exercise patience in order to confirm the breakout. Having the candle close above the range is one of the strongest possible signals for a continued upward movement. Once you have determined your entry, you'll need to have your exit strategy in place. A good way to determine a reasonable target profit is to analyze the previous price movements of the financial instrument. Your exit strategy will largely depend on the specific trading circumstances, trading style, your expectations, and the risk-to-reward ratio you're using. The balance you have to consider when placing your stops to exit your trade is to set them not too far so that you don't lose too much money if the market turns against you, and not too close so that small price fluctuations take you out of your trade too early. In this case, we could decide to place it right about here, which would be at our maximum permissible loss. One thing to look out for when trading breakouts is fake breakouts. Fake breakouts occur when the price breaks past the support or resistance level, but instead of continuing its movement, the price moves back into the previous trading range. So here we can see that the price breaks outside of the range but does not close above it. Instead, it returns back into the trading range and does not continue its movement upwards. So if you had placed your entry here, you would in fact have been caught in a fake breakout. In order to decrease your chance of trading a fake breakout, we suggest you wait to see if the price will continue to move in the intended direction. For instance, it's good to wait for a new high before going long. In this way, you will sacrifice some of the momentum of the trend, but you will ensure it's going in the direction you anticipate. Let's go to the Trading 212 Pro platform to illustrate a real live example of trading a breakout. Here we have the US dollar Japanese yen chart in candlestick mode at a 1-day time interval. Each candlestick represents the trading activity of 1 day. The first thing you needed to do is to have a clearly defined trading range. You can of course just have a support or resistance level, but we are going to go with the trading range as it's more beneficial. We see here well-defined tops, here and here, creating a resistance level, and clearly defined bottoms, here and here, that create a definite support level. Here we can see that the market has tested the highs and lows quite a few times, and we can be fairly certain the market won't hold this for much longer, and so you can expect a breakout. It may be tempting to enter the market when it's volatile and moving fast like over here, but this may lead to rushed decisions that won't result in the desired outcome. So a better strategy is to position yourself so that you're trading stocks, commodities or currency pairs that are currently low in volatility like we have here, and place your order so that it is ready to ride the trend whenever the breakout occurs. So you would need to place your entry order just above the high or just below the low so that your order is automatically entered when the price moves. To see more information on this, you can refer to our video on entry orders. Thank you for watching this tutorial on trading breakouts. We wish you successful trading with Trading 212.